Is Bitcoin's underperformance just a fluke of market hype, or is it a symptom of bigger shifts in global attention and capital flows? If AI stocks and precious metals are stealing the spotlight, why does it feel like Bitcoin is stuck in neutral while everything else surges? And if Bitcoin is built to thrive as a decentralized asset, why hasn't retail adoption kicked in to drive the next big wave? According to Lyn Alden, the real story isn't about Bitcoin failing. It's about competing narratives and mediocre demand in a crowded asset landscape. Those who see beyond the price charts can spot the long-term asymmetry, positioning themselves for when sovereigns and self-custodians finally step up, while others chase fleeting trends too late. Hello everyone, and welcome back to our channel. This podcast summary video is based on Lyn Alden's recent appearance on Coin Stories with Natalie Brunell, where she delivered one of the most balanced and insightful macro breakdowns of Bitcoin's cycle we've heard in a while. The conversation covers Bitcoin's disappointing run, negative sentiment, the absence of retail buyers, competition from AI and precious metals, institutional effects, broader economic trends, and why diversification might be the key to surviving volatility. The whole conversation is almost 1 hour long, but we listened to it all and organized the most important ideas into a clear, straightforward summary, so you get the key takeaways without having to listen to the full episode. If you get value from our summaries, please like the video, subscribe to the channel, and comment your thoughts below, because that really helps the channel and keeps this content coming your way. Lyn starts by acknowledging the elephant in the room. This Bitcoin cycle has been disappointing, peaking at just $126,000 when many expected much higher, like her own threshold of $150,000 or more for it to feel successful. But she remains optimistic about its long-term upside, calling Bitcoin a still small asset with significant potential, much like how gold and silver rally despite their massive markets, showing that even established assets can have explosive moves. In her view, the negativity feels worse than the 2022 bear market, with even long-term holders turning pessimistic and expressing frustration online and at events. The vibe at conferences is notably down, and broader crypto narratives have fizzled out, creating a persistent drag that weighs on the entire space. This isn't a Bitcoin-specific issue. It's a cycle without the usual sparks like viral trends or widespread excitement, making it feel fundamentally different from past booms where energy was high even at bottoms. One big mystery Lyn unpacks is the lack of retail adoption, which she sees as a key missing piece in this cycle. Unlike previous cycles where Bitcoin's outperformance drew in everyday investors curious about why it was beating everything else, this time it got overshadowed by soaring AI stocks like those tied to RAM and GPUs, plus a strong precious metals bull run that captured speculative attention. Retail thrives on FOMO. When an asset crushes everything else, people pile in to learn more and get involved. But with Bitcoin just doing okay, while other sectors exploded, that magnetic pull wasn't there to bring in new blood. Sovereign buyers didn't show up either, despite all the hype around ideas like a US strategic Bitcoin reserve. Lyn was skeptical from the start, warning not to count on it materializing quickly. Instead, the action came from institutions and high-net-worth folks via ETFs, but without the grassroots elements like self-custody or widespread education on podcasts and social media. The result? A barbell missing both ends. No retail frenzy to drive hype and no nation-state buys to add legitimacy and volume, leaving the market feeling stagnant and anchored by broader crypto fatigue. Lyn dives into how institutions are changing the game, noting that their entry via ETFs and derivatives has dampened Bitcoin's wild swings. Peaks aren't as euphoric as in retail-driven eras, and crashes might not be as brutal either. As Bitcoin grows more liquid and mature, it's harder for single events to dominate, like a failed exchange in the past that could tank the market overnight. But she points out that paper games, like those seen in gold where derivatives inflate supply for years, won't last long in Bitcoin because custody is easy to test and insolvency can be exposed quickly. Overall, she sees this as healthy evolution. Fewer 90% crashes as the asset matures and integrates into traditional finance, though it does create an environment where suppression on both ends limits the upside potential some expected. Still, the top-line demand was mediocre this cycle, lacking the explosive upside from previous booms. And with volatility still present, she warns we'll see how low it goes in this bear phase, potentially testing lower levels before stabilizing. Shifting gears, Lyn shares her evolving take on precious metals, explaining how she was bullish early when they were undervalued. Silver at $18 per oz felt like a no-brainer with strong industrial demand and potential monetary upside, offering a high floor and significant asymmetry. But after their recent rallies, where gold took off first and silver/platinum caught up dramatically, they're less asymmetric now. A 50% pullback or new highs wouldn't surprise her, as the easy gains from being near mining costs are gone. She contrasts with super bulls like Luke Gromen, who sees gold hitting $10K. $15K as a revalued monetary anchor to address global debt, potentially shifting from treasuries back to hard assets. Lyn agrees it's possible, but stresses probabilities and timelines. It's only a double from current $5,000 levels, with real downside risks if sentiment shifts, and she wouldn't bet everything on it happening imminently. Broader macro, U.S. stocks look strong nominally, but are in a bear market versus gold, marking the fourth major such period in modern history, reflecting fiscal dominance, currency debasement, and top-heavy wealth distribution, where stocks are 200% of GDP and the top 10% drive nearly half of spending. Consumer sentiment is low despite market highs, mirroring emerging market woes where inflation erodes purchasing power quietly, even if stocks hold up in local terms. This is where Lyn widens the lens to AI and the economy, highlighting how AI's massive energy hunger for data centers, GPUs, and RAM creates bottlenecks that compete directly with Bitcoin mining, though AI prefers low-latency locations near users while miners chase stranded cheap power. She predicts typical boom-bust cycles leading to oversupply in these inputs, ultimately boosting global productivity like tractors did for farmers by giving workers AI agents to enhance efficiency. Bitcoin fits AI perfectly. It's permissionless and self-custodial, ideal for micropayments and value transfer between agents who can't easily KYC for traditional banks. On the macro front, expect a gradual print from the Fed, starting small like $40 billion per month in balance sheet expansion. Not a nuclear QE of $2T, plus unless major crises like wars or pandemics hit. Current bank cash ratios are high, limiting the need for big interventions. Liquidity is at record highs, but divergent from Bitcoin due to AI distractions and valuations, with correlations breaking 17% of the time historically. Reshoring? Unlikely to scale fast. U.S. manufacturing jobs are actually down despite efforts, as it competes with AI for power, labor, and resources in an uphill economic battle. Societal unrest could linger into the 2030s from wealth inequality, AI job fears, and fiscal dominance feeding polarization. Dividends are at record lows amid sky-high valuations and a shift to buybacks, echoing dot-com bubble levels where yields dipped to just over 1%. Lyn's advice cuts through the noise. Diversify, even if it's unfashionable among Bitcoin maxis during bulls, because it shines in bears. Spread bets across assets like Latin American banks, surprising 2025 standouts amid trade wars, or metals to buffer against underperformance. Psychology matters hugely. Avoid financial nihilism, like chasing risky alts or memes to catch up on missed gains, as that often leads to heartbreak rather than wealth. Bet big on yourself instead. Start businesses, leverage AI tools for productivity, since the world has never been more accessible for entrepreneurs with cheap resources like open-source AI. If feeling vulnerable from volatility, especially for late entrants who stacked heavily hoping for life-changing upsides, reassess your allocation. Concentration is fine, e.g., 20% in Bitcoin for high conviction, but not 90% that forces sales and weakness. Ignore echo chambers and their all-or-nothing rhetoric. Sentiment feels worse than 2022 because hype around ETFs, pro-Bitcoin politics, and reserves went unmet, creating cognitive dissonance for those who feel behind and gambled big, but diversification provides dry powder to shift assets without panic. So where does this leave us? Lyn calls herself a bearish bull. Bitcoin's core thesis holds strong. A decentralized ledger worth far more than its current 0.2% of global assets, with powerful network effects cementing its dominance over alts, as evidenced by no real alt season and Ethereum still far from new highs in BTC terms since 2017. Demand for self-custodial hard money should grow organically, especially as AI narratives evolve and highlight Bitcoin's fit for digital agents. But education remains key. to showing people the tools for privacy, payments, and savings. This downturn is more of a grind than a V-shaped bottom, with supply tightening in diamond hands holders setting the stage for even marginal new demand, like from peaking AI stocks to spark fresh runs. The deeper shift? Bitcoin competing on its own merits amid macro resets, gradually embedding as collateral or household savings against debasement. If AI hype peaks and capital rotates back, what feels stagnant and disappointing today could explode in hindsight. The question isn't if volatility ends. It won't, as markets always cycle. It's if you grasp the bigger picture. Bitcoin as enduring, portable infrastructure in a world of fiscal uncertainty and technological disruption.